Good morning, ladies and gentlemen. The time is 10:05. Today is the 22nd of March, and I'm done with my trade for the day. Um, it is over. I exited around 9:51 and just got out of the position because, as I've been saying lately, I've been very nitpicky with which trades I want to stay in and which trades I want to take and not take, especially when it is Friday, Monday, or Tuesday. Closer to expiry, probably there are cases that can be made for it being worth to stay in the trade for longer. But as of now, I will wait for conditions to either be how I want them to be, or I will not be in the trade. So that being said, let's get into today's trade. First of all, last night US markets little bit of a red, not much. S&P almost flat, Dow down about 0.5%, and Nasdaq down 0.3%. So really not much red there. And apart from that, we saw that futures this morning were also slightly in the red, not by much, just slightly. So that profit booking sentiment probably to continue, and 17,500 now obviously looking like ceiling territory for this particular expiry. Now, all that being the case, there was still a pretty good crush in premium overnight. The particular triangle I was trading, 16,700 and 17,500. It closed yesterday at close to 110 rupees, and it opened this morning for around 86, 87 rupees. So I still entered that trade because I thought that we're still in a relatively higher IV environment. On a Tuesday, you're getting 85 plus points for an 800 points triangle. It's worth testing out the waters. So that's why I entered my position. Now there is a premium skew, but my idea is I want to be equidistant. Now the question is, okay, the put side has 1.5 times the premium of the call side. Why that? Simply because there is a skew. In case we open flat and we make an up move, the put side credit will not really help me too much against the call side expansion. Whereas when I'm equidistant, 400 points up on the call and 400 points down on the put, then that kind of gives me a situation where my position will not react too quickly into either an up move or a down move. So like, for example, if this goes from 51 to 55, this will go to 29. So it will balance. Doesn't have to be exactly same premiums all the time, and in different environments of volatility, you would want to structure a little differently. Reliance showing a lot of strength. Now, what exactly happened? I entered my trade here at the open, and from there we had a steady down move. My idea was that as long as this particular level holds, then I will stay in the trade. Else, if this particular level breaks, then I will exit the trade. And the reasoning for that is, if you see what happened with the premium, the call side gave up a considerable amount of premium. So calls were trading at 27, 28, and the puts were starting to break yesterday's closing price of 55. So you see they were heading up to 54. My first square off here, and I'll tell you why. So if you see yesterday's closing price, it's here. The first time it breached, it was fine. But the second time, just as it started to take out the high of this particular candle, this was not looking very attractive to hold because there was really not much premium left in my call side in order to be able to balance this trade. And I have no interest in making adjustments. This is not the correct volatility environment to be making adjustments. Either like you take a stop loss on the trade, take a trailing stop loss on the trade, or you get out of the trade. I'm not particularly too amped about doing too many adjustments in the current volatility environment because it's been so erratic, the up and down moves, at least over the few weeks, where you make a 200 point down move and then 300 point up move, and any adjustments you do will just royally backfire. So instead, what I did was I entered the trade, it got a little more than 5 points, and decided to call it right there. I exited this because it's already trading much cheaper, almost 3 points cheaper than where I exited it. But I felt that given how the past few weeks have been playing out, it's best to keep your risk low and trail profits early. And even if I'm booking early, that's fine. We will wait until we can see that clearly we are going to hold in some particular range, because the movements have been too erratic. And also one more thing, look, a level like 17,000, if tested, will lead to a tremendous IV spike. The point where I exited, we were at 1750. The thing about being at 1750 is, if we just make another 20-30 point down move, we'll be very close to 17,000. Once we're at 17,000, that can trigger a lot of put side short covering. And you'll see that that'll lead to an IV spike where puts are gaining, but calls are not giving up anything. And that also is a pain. So I don't like testing of numbers like 17,000 or going closer there. It's a dicey spot to be in. Anyway, thank you so much for watching. I think once again, the summary of the day more or less is be very picky and choosy about what kind of trades you take and where you book. And yeah, that's the end of the day. I'll catch you at the next one. Take care. Bye bye. Also, if there's like a tremendous IV spike, something that I did yesterday, I posted on Twitter. Like the spread I exited gained nearly 25 points after I exited. So I took a wider trade, which was like 1,200 point wide strangle, wherein just a cool off in IV will benefit it with a minor stop loss of 2 points, and just trailed that to the end and got another 6 points from that. So that is something that I might consider if we break 17,000 today, and I feel like that has been a good enough spike in IV for it to warrant a re-entry. Thank you so much for watching. Have a great day. Bye bye.